Welcome back to the Daily Crypto Roundup. Today's episode is about understanding the drop, not reacting to it. Over the last 24 hours, crypto markets have moved lower again. Bitcoin has slipped below $90,000. Ethereum has cooled back toward $3,000, and altcoins across the board are under pressure. Headlines are everywhere: tariffs, politics, macro fear, liquidations. And as always, when markets pull back, the noise is louder than the signal. So today we're going to slow it down and do this properly. We'll go through the prices, then we'll break down why the market is down, what actually caused the move versus what merely triggered it, what the data is telling us underneath the surface, what analysts are saying, and what matters going into the next few days. This isn't about panic, and it's not about blind optimism either. It's about context. And before we get into it, a quick reminder. We're still running the XRP giveaway. So if you've got thoughts on today's episode or the market in general, drop a comment and you'll be in the mix. Let's start with where prices actually are right now. Bitcoin is trading at the $90,000 range, having slipped below $93,000 earlier after a sharp move lower. Ethereum is sitting around $3,000, down from last week's highs but still above key long-term support. XRP is hovering to just $1.90. Solana has pulled back to $130. Binance Coin is just under $895. Cardano is 35 cents, and Dogecoin is trading around 12 cents. The important thing to understand here is that this move has been broad-based. This wasn't one coin blowing up because of a protocol issue. This was a market-wide repricing, with nearly all major assets moving lower together. When that happens, it usually points to macro or structural pressure, not coin-specific failure. Now let's talk about the immediate catalyst, because this is what most people are reacting to. The main headline that most people are reacting to today centers around renewed geopolitical tension and trade-related rhetoric out of the United States. Fresh reporting around potential tariff escalation between the US and the European Union has pushed global markets briefly into risk-off mode. That risk-off shift showed up very clearly across asset classes. Gold caught a bid and pushed higher. The US dollar strengthened, equity markets softened, and crypto, which continues to trade as a high beta risk asset rather than a safe haven, moved lower first and fastest. This isn't unusual behavior in the current macro environment. Despite long-term narratives around Bitcoin as digital gold, the reality today is that when global risk sentiment wobbles, crypto is still treated by markets as a speculative asset that reacts quickly to uncertainty. That said, it's important to be precise about what today's headlines did and didn't do. The tariff rhetoric didn't create the conditions for this drop on its own. It acted as a trigger at a moment when the market was already fragile under the surface. Bitcoin had rallied strongly earlier in the month and was trading near resistance. Leverage had quietly built up in derivatives markets, with many traders leaning on continuation higher. When the macro headlines hit and price slipped through short-term support, liquidation engines were triggered, and that's where the real acceleration happened. Over the course of the move, roughly $800 million to $900 million worth of leveraged long positions were wiped out across the crypto market. Bitcoin and Ethereum accounted for a large share of those liquidations, but the knock-on effect spread quickly into altcoins as collateral values fell and forced selling cascaded. This kind of selling is mechanical rather than emotional. It doesn't reflect a sudden collapse in belief about crypto. It reflects traders being forced out of positions they no longer had the margin to maintain. Once those positions are cleared, price action often slows and stabilizes, which is exactly what we started to see later in the session. What's notable today is what didn't happen. We didn't see mass spot selling from long-term holders. We didn't see a surge of coins rushing onto exchanges. We didn't see institutional capitulation. On-chain data suggests that large holders have largely stayed put, even as short-term traders were flushed out. That distinction matters, because in genuine bear market breakdowns, long-term holders usually join the selling. That's not what today's data is showing. In fact, alongside the selling headlines, there are still very real accumulation stories playing out in the background. Earlier this week, Michael Saylor's company Strategy, formerly MicroStrategy, disclosed another enormous Bitcoin purchase, adding over 22,000 BTC for more than $2 billion. This marked the company's largest buy in months, and came as prices were already showing weakness. That kind of accumulation doesn't get the same attention as liquidations on social media, but it's far more meaningful for long-term structure. It shows that corporate and institutional players with long-time horizons are willing to add exposure during volatility, rather than chase momentum at highs. We're also seeing this divergence in investment products. While short-term ETF flows have cooled and even turned negative on some days during this pullback, there hasn't been a wholesale exit. Ethereum-linked investment products have actually continued to see modest inflows, suggesting that some investors are rotating rather than abandoning crypto exposure altogether. Retail participation, on the other hand, remains muted. Funding rates are neutral to slightly negative, indicating a lack of aggressive long positioning, and a market that's still cautious rather than euphoric. From a technical perspective, analysts are watching a very narrow set of levels today. For Bitcoin, the $90,000 to $92,000 area is now the key zone. That region is both psychological and technical support, aligning with prior consolidation. We dipped toward it during the liquidation flush, but so far it has acted as a stabilization point rather than breaking decisively. Ethereum is showing similar behavior around the $3,000 to $3,200 range. A clean break below those levels would likely invite further downside, but as of now, price action suggests consolidation rather than collapse. Several analysts have weighed in on this behavior today, warning that while the longer-term structure still looks intact, the market remains vulnerable to further volatility if macro uncertainty persists. Some have pointed out that if Bitcoin fails to reclaim the $95,000 area convincingly, downside targets in the mid-$80,000 could come into play. Others see the current move as a textbook leverage reset that improves market health by clearing excess positioning. The common thread in analyst commentary today is caution rather than panic. This isn't being framed as the end of a cycle, but as a market that's searching for balance amid competing forces. An interesting development today is that Pakistan has signed a memorandum of understanding with a US-registered crypto company linked to World Liberty Financial, a project associated with the Trump family, to explore the use of a US dollar-pegged stablecoin called USD1. The agreement involves Pakistan's Virtual Asset Regulatory Authority and the State Bank of Pakistan, and focuses on assessing whether a regulated stablecoin could be used within the country's financial system, particularly for digital payments and cross-border remittances. The move is significant because it represents one of the clearest examples so far of a sovereign state openly testing the integration of a privately issued, dollar-backed stablecoin rather than rushing straight to a central bank digital currency. Pakistan receives tens of billions of dollars a year in overseas remittances, and officials see blockchain-based settlement as a way to reduce costs, speed up transfers, and increase transparency compared with traditional banking rails. There is also a clear geopolitical and political dimension. Partnering with a US-linked crypto firm suggests closer financial alignment with Washington at a time when digital finance is becoming strategically important. While the project is still exploratory and far from full deployment, it highlights how governments are increasingly viewing stablecoins not just as speculative tools, but as potential infrastructure for real-world payments and international finance. In other news today, the US Federal Reserve has injected approximately $8.3 billion into the financial system through short-term liquidity operations, a move designed to keep funding markets stable amid rising macro uncertainty. While this is not a return to full quantitative easing, the timing is notable, coming as global markets show signs of stress and investors rotate heavily into traditional safe havens. For crypto markets, the picture is mixed. In the short term, risk aversion has weighed on prices. However, historically, increases in system liquidity have eventually supported speculative and high-volatility assets once confidence stabilizes. Traders and institutions are watching closely, as shifts in Federal Reserve liquidity often act as an early signal for future capital flows back into assets like Bitcoin once macro conditions improve. Looking ahead, there are several real risks and catalysts to watch over the next few days. Geopolitical headlines remain unpredictable, and any escalation or de-escalation in trade rhetoric could quickly shift risk sentiment. Macro data, particularly around inflation and central bank policy expectations, will continue to influence crypto as part of the broader risk asset complex. token unlocks scheduled for the coming days may add short-term selling pressure in specific assets, even if the wider market remains stable. The key takeaway from today's news is that this move down is not the result of a single failure or loss of confidence in crypto itself. It's the result of a market that had become extended, leveraged, and vulnerable, encountering a macro headline that triggered a mechanical reset. That's an important distinction, because it changes how you interpret what comes next. Markets that break due to fear behave very differently from markets that pause due to positioning. Right now, the crypto market appears to be in a phase of reassessment rather than surrender. Sentiment has cooled, leverage has been flushed, and price is testing whether buyers are willing to step in at key levels. This is the part of the cycle where patience matters most, because overreaction on either side tends to be punished. As always, the goal with this roundup isn't to tell you what price will do tomorrow, but to help you understand why it moved today. We'll continue tracking these stories as they develop and bring you the next update as soon as the picture changes. This is the part of the cycle where patience matters most. Overreacting here is how people get chopped up. The better approach is to watch structure, watch behavior, and let the market show its hand. As always, don't chase green candles, don't panic on red ones, and don't let headlines make decisions for you. Drop your thoughts in the comments, make sure you're in for the XRP giveaway, and let us know what you're watching over the next few days. Thanks for listening, and as always, we'll see you at the top.